As the U.S. markets are closed for trading on this Friday, October 24th, 2025, we are looking at the final figures from yesterday's session. Nuburu Inc., ticker BURU, closed the day on Thursday, October 23rd at 0.3411 per share. This represented a significant intraday drop, finishing the session down 4.61% or 0.016 on what was truly massive trading volume, with over 120 million shares changing hands. That's a staggering figure for a stock with a market cap of only around $45 million. Now, when you see a sub-dollar stock moving with that kind of velocity, the immediate expectation is that this is just noise, a pure speculative gamble that traders on the Robinhood app or those using SoFi Active Investing are pushing around. The common belief is that Nuburu is a tiny, cash-burning laser company with some interesting tech for welding copper, maybe for EV batteries, but that it's ultimately just a lottery ticket. That expectation, however, completely misses the profound, high-stakes corporate battle and strategic shift happening right now. The reality is that the company you thought Nuburu was, a simple blue laser developer, is effectively being dismantled and rebuilt from the ground up in real time into something else entirely, a defense and security holding company. The 0.34 price tag isn't just about lasers, it's the market's price for a ticket to one of the most aggressive and risky corporate transformations on the entire exchange. Let's establish the common ground, the story most people know. Nuburu came to market with a compelling high-tech narrative. It's a pioneer in high-power blue laser technology. This isn't just a gimmick. Its specific wavelength is physically superior for processing reflective materials like copper, aluminum, and gold, which are notoriously difficult for traditional infrared lasers. The primary application, and the one that got everyone excited, was in welding copper components for electric vehicle batteries. With the entire world shifting to e-mobility, a company with a core technology for building batteries better and faster seems like a surefire bet. You look at the titans like Tesla stock and the broader EV supply chain, and you see a massive addressable market. This is the story that likely drew in many retail investors, perhaps doing their own online investing on platforms like the Fidelity mobile app or SoFi Invest, seeing a low-cost entry into a high-growth field. The expectation was simple. If they get one major contract from one major battery or automaker, this stock, currently trading for pennies, could see exponential returns. That was the dream. Now let's challenge that narrative with the cold, hard reality of the last 12 months. That dream has been collapsing. The Q2 financial report, our last clear look under the hood, was bleak. The company had just $111,090 in cash and cash equivalents as of June 30. That is not a typo. $111,000. Revenue for 2024 was a disastrous $152,000, down from over $2 million the prior year. The company is bleeding cash with an accumulated deficit of over $150 million. Its own filings have carried a going concern warning, which is accounting speak for we may not have enough to keep the lights on for another year. The core blue laser business, despite its technical merits, has failed to launch commercially. The adoption cycle is painfully long, cited at 22 to 24 months, and the company simply doesn't have the time or the capital to wait. This isn't a pre-revenue growth story anymore, it's a story of survival. This financial distress is the reality that underpins the stock's collapse from its 52-week high of nearly $1 to its low of just 12 cents. It's the kind of stock that would give a fiduciary at a Fidelity wealth management firm nightmares and would never find its way into broad Fidelity mutual funds or a stable portfolio like Schwab Intelligent Portfolios. This is the domain of pure speculation. This is where the story pivots, and it's why we saw 120 million shares trade yesterday. When a company is on the brink, it has two choices: fold or attempt a radical change. Nuburu, under the leadership of its executive chairman and now co-CEO Alessandro Zamboni, has chosen the latter. The company is in the midst of a transformation plan. This isn't just a marketing buzzword, it is a complete gut renovation of the entire business. Forget the slow-burn EV battery market. The new strategy is to use the company's public shell and whatever's left of its laser IP to rapidly acquire and build a defense, security, and operational resilience conglomerate. This is not an exaggeration. Look at the press releases from just the last 30 days. On October 1st, the company implemented a dual CEO structure, appointing Zamboni and Dario Barassani to lead this new charge. On October 7th, Nuburu announced it was acquiring Orbit SRL, an Italian SaaS company specializing in operational resilience. This has nothing to do with lasers. It's a software business they hope to scale. Then, just 2 days ago, on October 22nd, came the biggest news: a strategic alliance with Maddox Defense to form a new joint venture. This JV, controlled by Nuburu's new subsidiary Nuburu Defense, aims to build and deploy advanced military and commercial drone systems. The company is throwing out projections of this drone business approaching $100 million in annual revenue by 2028. This is all part of a larger plan to acquire another Italian defense company, Tecne, which Nuburu claims has an existing order book valued at approximately $500 million. So let's connect this back to the stock chart and that insane volume. The market is trying to price two completely different companies. On one hand, you have the old Nuburu, a failing, cash-starved laser tech company worth its 12 cents low. On the other, you have the new Nuburu, an aspiring defense contractor that claims it's bolting on hundreds of millions in revenue via acquisitions and JVs. The volatility is the war between these two narratives. The massive volume is traders trying to decide if this is a brilliant strategic pivot or a desperate Hail Mary pass. The recent news has been a whirlwind. On October 13th, the stock was hit after the NYSE American exchange sent it a warning letter. This wasn't about its low price, but about a procedural failure. The company announced its new dual CEO structure without giving the exchange the required advance notice. This kind of governance slip-up is a red flag for institutional investors using sophisticated platforms like Interactive Brokers, as it suggests the company might be moving too fast and cutting corners. Just 3 days later, on October 16th, the company announced it had regained compliance with the NYSE's listing standards, resolving a separate prior deficiency. This push and pull, a governance error followed by a compliance resolution, is a perfect micro-example of the chaos surrounding this stock. But how is this transformation being funded? This is the most important question for any self-investing individual looking at this stock. The answer is massive, painful dilution. In mid-September, Nuburu completed a $12 million public offering. While $12 million in fresh cash was desperately needed, the price was disastrous. The offering was done at just 0.1428 per share. To get this deal done, the company also had to issue common warrants to purchase an additional 126 million shares, with an exercise price of just 0.1714. Let that sink in. There is now a ceiling of 126 million shares that can and likely will be sold into the market every time the stock ticks above 17 cents. This is a massive anchor on the share price. It's the cost of survival. That 12 million is what is funding the initial payments for the Orbit and Techne acquisitions and getting the drone JV off the ground. So, while new buyers are excited about the $100 million drone projection, they are buying into a company whose share count has exploded and is poised to explode further. This is a critical detail that casual online investing on a simple SoFi trading platform might miss. The dilution is the price of the pivot. What about the original blue laser technology? It hasn't been completely abandoned. The new strategy is to reframe it. Instead of being the entire company, the laser IP is now pitched as a key enabling technology for the new defense applications, perhaps for drone manufacturing or for other advanced defense hardware. This is a smart way to salvage the IP and integrate it into the new narrative. But make no mistake, the core business is now acquisitions and defense contracts. The company you are investing in today is not a laser company. It's a holding company